You're 55 years old and you're retired, with most people's dream situation, $1 million sitting in your 401k. But the question is, should you start the conversion from these dollars being in a 401k to a Roth? That's what we're going to look at in our episode today. Hello, my name is John Vandergriff. I'm one of the owners and lead of the wealth planning team here at Blue Ridge Wealth Planners. We help people in the discussion of retirement planning, and one of the key parts of that is tax planning in the way that we look at things. And so we look at conversations like this all the time and want to share a little bit of what we do. As you've seen, from our channel, we've got lots of different videos that cover these type of topics. So again, click the link or the like or subscribe below so that you can continue to get this content. But today we're looking at a particular situation. Age 55, retired individual with $1 million, should they start to convert this to a Roth account? And so that's what we're going to look at in our situation today. As we always do, we say, this information is for educational purposes. This is not a recommendation. We believe that it's wise for you to work hand in hand with a tax professional. We use our CPAs and tax preparers for our clients, making sure that we know all the information that we need to when it comes to somebody's income situation. So I would highly advise that. But yeah, as we get started here, and we said, our company works on what we in retirement call a plan for everything. And so as you'll see, tax planning is just one of the 5 key areas that we walk people through: income planning, investments, taxes, healthcare, and family legacy. All of these things are very important. All of these affect your money, and what you're going to see is how much overlap there is, particularly in the income and taxes as we look at things today. So again, it's very important to make sure that we plan for all of these and don't just silo in on one area. And so we want to make sure that we get a good holistic plan. So what we're looking at today is a single 55-year-old who needs, income-wise, $8,000 a month. They have pension income, which has allowed them to retire early, of $5,000 a month. And then they've got, in addition to that, $1 million in their 401k, $200,000 in bank or non-qualified after-tax monies in between brokerage accounts and savings accounts. And then once they cross over into Social Security age at 62, they'll be able to add another $1,600 a month to a very healthy pension income today. So what this looks like from a income perspective is this person has got a lot of income that is going to be with them for the duration of their life, because this pension is going to be there. Social Security is going to add on top of that. So, in perpetuity, they're going to have $6,600 a month coming in, and that means any money that comes out of this 401k is going to be taxed on top of that $6,600 a month, which is important to note because when we look at this, that's what's going to be the basis of whether we make the recommendation to convert or not. Is going to be based on where the income taxes are now versus where those income taxes will be later on that income. So as we look at this, because this person's under the age of 55, there are a couple things that we need to point out when it comes to Roth conversions. First, if you convert dollars under the age of 59 and a half, any of those conversions must wait 5 years before you are able to withdraw any money from that particular account. And so this particular situation, they've got enough after-tax money to be able to get them to age 59 and a half or to the 5-year mark where they could buy time before they needed to touch anything from this Roth. So that's not necessarily a hindrance here, even though this person is retired. But we definitely don't want to reckon with a 10% penalty on any kind of monies that we have growing tax-free. We want to be able to get those tax-free benefits if we're going to do those Roth conversions. Now the second, any dollars withheld for taxes from a 401k under the age of 59 and a half would count as a withdrawal. Even though they're not going to you, they are going to the government, and those withdrawals would incur a 10% penalty. Now, there's a little wrinkle here. This goes in effect typically for 401ks that are either in force, in service, where someone's still working, or IRAs for sure will fall under this, no question. But if you have a 401k that you have separated from employment with, you benefit from what is called the Rule of 55. And so what this means is if you separate from your employment with a company and you leave those assets inside of a 401k account because you have reached the age of 59 and a half, or 55 rather, you can take taxable distributions. So the money coming to you will be taxable, but those monies will come to you and avoid a 10% penalty for early withdrawal. So because those assets are coming to you straight from the 401k and you are age 55 or older, you get the benefit of this because you have retired. This made it to where you could retire before the age of 59 and a half and not have all of your assets locked up. So this particular situation, because this person is retired, they are able to benefit from that rule of 55. And so what we would look at is if they wanted to do a conversion, they could do that, and then separate from that, take a tax withholding either from those assets or pay the taxes out of their after-tax monies that they have in bank type accounts. So again, to refresh, let's look at this situation. Single person needs $96,000 a year. They're getting $60,000 a year of pension income. So from this bucket of $1.2 million, they need $36,000 a year to support them until Social Security kicks in. Then they'll add another $19,000 to their income, decrease the amount that they need from their savings. But as we look at this from a taxable income perspective, they are at minimum $60,000 of taxable income because of the pension, which would put this single person in the 22% tax bracket. So that's where we start from a conversion, because as we look at this, all conversions would be your most tax heavy money in any particular tax year. So take all the income taxable sources you have, stack them together. A dollar comes out of a 401k, that is now taxable on top of, in this case, $60,000 of income. So again, that's where we're starting is 22%. $1 million in the pre-tax, $200,000 in after-tax, so they could either pay taxes out of this money or pay their income here and leave their taxes at $60,000, either way. So as we look at this, again, to justify, this is the single filer tax brackets for the age or the year of 2022. So again, this is what we know. We know that because this person's over $54,000 of income plus deductions, they're in the 22% tax bracket at minimum, and then up from there depending on what distributions they move into a Roth or take out as taxable income because of that rule of 55. Now the problem when we look at this is we don't know what those tax rates are going to be in the future perfectly. Here, if the current tax code that exists now expires, it will go back to the way things were in 2017. That means this particular individual would be at the 25% tax bracket instead of the 22. So that's something that we've got to pay attention to. And then if taxes got worse than that, which I think is very likely, one of the years that we look at here is 1981, because this was the last time that the upper tax brackets were significantly higher than we've seen in a long time. And this particular person at $60,000 of income would be pushing the top of the 30% bracket, which is noticeably higher than where they are today. So as we look at this conversation around Roth conversions, the main thing that we have to look at is, does it make sense to do this? What is the thing that really matters when we're trying to compare now versus later in a Roth conversion? So I want to share an example with you that we will normally share when we're having this discussion. I'm going to use $100,000 here as just a good round number. And so in this case, this money is in a 401k. And so we're looking at this saying, does it make sense to leave it on the path of a 401k, or do we take this money and convert it over to a Roth account, either an IRA or a 401k? If we do that, and I'm going to look at this from an apples for apples comparison because I think that's the most fair way to do it, where, if we're looking just at the assets in this account, if we leave it in the 401k, you will see there are no changes to that 100 because no taxable event has occurred. Once this money moves to the Roth, it adds $100,000 to, in this case, $60,000 of income. And if the total tax bite there was just 20% and that was withheld from this account, that means we've got $80,000 that would be starting in the Roth account. And so some financial advisors will stop you here and they'll say, this is not a good deal for my client because if the market grows, this 401k is going to make much more money than the Roth. And on the short term, that answer is correct, because we're not at an equivalent situation. This bucket has no taxes owed. This bucket has all of its taxes owed. So we've got to continue down this example and see where we end up. And assuming that we invest this money the same way, same length of time, which will take care of time value money calculations, also take care of inflation. If we've got a Roth account that is now worth $160,000, the 401k that is now worth $200,000, we've got to look and see what is the impact of taxes at that particular time. Now the Roth, it doesn't matter, because as long as this account has been in place for, as we said, longer than 5 years, the entire bucket is available tax-free. The 401k, it matters a lot what the tax situation is at that time, and if the tax brackets were the same as they were at the beginning, the bottom line numbers are the same. So what we're after when we're trying to make the decision to do a Roth conversion is, when can we pay the lowest tax percentage? That is the only thing that matters. It's not the tax dollar, it's the tax percentage on that dollar that we've got to focus on. Because, as we look at it, the way most of us have been taught to evaluate income and taxes in our retirement years is to say, oh, well, our income is going to be noticeably higher while we're working, so we want to make sure that we defer all those taxes till retirement. The problem is, just because you have a lower income in retirement does not mean you will pay a lower percentage of tax on that income. But if the age-old sage wisdom when it comes to retirement planning is true, and your retirement dollar is less taxable than your work dollar, even though your Roth has been growing tax-free, you actually end up with more money, leaving it alone, staying the course in the 401k. That's why that advice has been good for so long. The problem that we're experiencing today is that the government has way overspent what they're bringing in from an income perspective and created a large amount of debt, and the only way to handle that debt is to have tax increase in the future, which is going to directly target the money that you have in IRAs and 401ks, because that money is 100% income taxable. So as we look at this, if that increase comes, and I don't know that it's an if, it's when, and how big will it be, what that means is that you're going to have potentially a more noticeable impact from a tax percentage on this 401k than you do now, which is what we've got to identify. Because if that's the case, you end up having less money in the 401k, even though your statement shows a higher balance than it would have been in the Roth. Because again, once the taxes are paid, now we're at an equivalent situation. And so if the taxes are less now, Roth conversions make sense. If the taxes are less later, Roth conversions don't make sense. Okay, it's that simple. So as we look at this situation, again, $60,000 of income for a single person. Starting distribution today would be 22%. If the tax code changes, it would be at 25%. Starting distribution at 1981 would be 30. So I believe now in this particular situation, this is the lowest opportunity to pay taxes. So then the question becomes, how much to convert? Well, again, if 25% is what we're potentially going into, and I think, won't get lower than that, just because of what we have coming down the pike for us with this large debt that the government has, we need to try to get as many dollars converted under that 25% as makes sense. So again, in this situation, there's another $42,000 that they could convert at 22%. If they wanted to maximize the 24% tax bracket, that would push them another $61,000 higher, and that would get them $103,000 converted into a Roth position this year, cutting down that $1 million 401k significantly, and they would have a 23% effective tax rate. And again, if our percentages hold true, I think that could be the lowest tax percentage that this particular person could pay on these 401k dollars. Because like we said, they're going to be at $60,000 at minimum the rest of their life, even if they wait until RMD time, which is age 72. That's when the government makes you start taking distributions. Those RMDs are going to start on top of not only the $60,000 of pension income, but also the $19,000 of Social Security income that's going to go on top of that. So as we look at this, a single person with almost $80,000 of income, even if they only take distributions out for RMDs, I think the percentage on that RMD will be higher than 23%, which is what matters in how we're being a good steward of the dollars that we have and paying off that tax debt as efficiently as possible. So in this particular situation, this is what we're looking at. Obviously, there are a lot of variables that go into this discussion that, again, we would like to know about from you individually, but also ways that we can help. So what you can do is, if you would like to click the link below in this video, schedule a time where we can discuss these things. We would be pleased and eager to do that in any way we can do to help you. If you want to continue learning about, obviously, what we're doing here and talking about, click like or subscribe to this video, and we'll continue to provide content and episodes here teaching you about Roth conversions and things that matter in retirement planning. So hopefully you enjoyed this in our time today. We look forward to sharing more information with you in the future and hope you enjoy this conversation.